Today, we're going to be learning how to commit tax evasion the legal way. If you watch this video to the very end, you'll learn how to take full advantage of your RRSP and minimize the amount of money thrown away in taxes every year. We'll start with the basics, just to ensure proper comprehension. RRSP stands for Registered Retirement Savings Plan. But in reality, it's more of an investment plan, not a savings plan. A lot of people tend to get confused about this. So here's an extremely simplified 30-second explanation about how an RRSP works. Step 1. Open an RRSP account with any of the big banks or an online brokerage. Step 2. Transfer money from your bank account to your RRSP account. If you decide to claim that amount of money as a tax deductible, you're going to reduce the amount of taxes that you have to pay by the end of the year. More on that later. Step 3, which is arguably the most important step, do your research and invest in assets with the money that you transfer to your RRSP account. Step number 4, let your investments grow in value and withdraw that money once you retire or when you want to buy a house. Now, you might be asking yourself, why should I even consider investing through my RRSP account? Well, an RRSP has two main benefits. The first benefit is that you get to defer your taxes to a later year during retirement. So whenever you put money into your RRSP, you delay paying taxes on them. You can then withdraw the invested money after retiring. And the cool part about this is that since after retiring, you'll most likely not be working your full-time job anymore, your income after retirement is going to be much lower than your income during your peak earning years. So if your income during retirement is much lower, you're going to be taxed at a lower tax bracket. And if you're taxed at a lower tax bracket, the government basically takes less money from you in taxes every year. The second benefit is that during the whatever number of years that your money stays inside your RRSP, that money will grow tax-free, assuming that you put it in different investments that grow in value over time. You're only going to be taxed once you withdraw that money after retirement. So now that we're all on the same page, let's dig deeper into each of the 4 steps to learn how your RRSP can help you save money on taxes every year, all while saving for retirement. Opening an RRSP is pretty simple and only takes a couple of minutes. Unlike a TFSA, there's no minimum age requirement when you come to open your RRSP, but the requirements are that you must have an earned income in Canada and you must have already filed a tax return. Also, you have to be a Canadian resident and have a valid social insurance number. Each year, the Canadian government sets a limit on how much money you can contribute to your RRSP. This contribution limit carries forward year over year and is the lesser of these two values, either 18% of the previous year's income or the yearly maximum set by the CRA, which is roughly $31,000 for 2023. So let's say, for example, that you made $100,000 in 2022. Then your maximum contribution for 2023 would be the lesser of these two values, either 18% of $100,000, which is $18,000, or the yearly CRA contribution maximum, which is approximately $31,000 for 2023. So in this case, the smaller value is the $18,000, so your contribution limit for 2023 is $18,000. Also, another thing to keep in mind is that the contribution deadline is not at the end of the calendar year. Rather, it's usually around March 1st of each year. So now that we discussed the contribution limit, which is the maximum amount of money that you can transfer to your RRSP account, let's dive into the fun part, which is the deduction limit. So as we said before, an RRSP allows you to reduce the amount of money that you pay in taxes by claiming a tax deduction on your income. Even though your RRSP contribution limit and deduction limit are related, they aren't the same thing. So an RRSP contribution limit sets a cap on the amount of money that you can contribute to your RRSP every year, whereas a deduction limit sets a cap on the amount of money that you can claim as a tax deduction every year. You can find your RRSP deduction limit on your notice of assessment, or if you go online on CRA My Account. A key thing to keep in mind is that your contributions don't need to be claimed in the same year that they are contributed. So you could technically contribute money every now and then and only claim that contribution as a tax deduction once you reach your peak income years. And actually, this is the smartest thing to do because during these peak income years, These are the years where you'd be paying the most money in taxes. Now, this is arguably the most important step, but a lot of people do tend to forget it or just ignore it altogether. Once you do transfer money into your RRSP, make sure that you invest that money. Because if you just keep your money sitting in cash, that money won't increase in value, and actually it'll lose value due to inflation. The RRSP is designed to serve as a retirement fund where you reap its benefits only once you retire. So there's a whole penalty system put in place to de-incentivize people from withdrawing money too early. But let's say that you're in a financial rut and you really need some cash from your RRSP account. If you withdraw that money too early, meaning before your retirement, the government is going to tax you a withholding tax, which is basically a penalty that you have to pay on the money you withdraw. And that penalty is between 10 and 30%, depending on the amount of money that you withdraw. And to make things worse, you also have to add the amount of money that you withdrew to your taxable income, so you'll eventually end up paying even more taxes on it. Also, once you take out money from your RRSP, you lose that contribution space forever. So the moral of the story is to not withdraw money from your RRSP before retiring at all costs. The only way to withdraw money from your RRSP before retiring without paying a withholding tax is through the home buyers plan or the lifelong learners plan. But these are a bit complex and I'll explain them in a later video. Once you retire, you can start withdrawing money from your RRSP without paying a withholding tax on that money. However, you'll still have to pay taxes on the money that you withdraw. But as we said before, assuming that during your retirement, you won't be earning a high income, you will most likely be in one of the lower tax brackets, so you'll end up paying less taxes on the long run. If you follow these steps and set a plan for yourself to be able to take full advantage of your RRSP, you'll be one step closer to financial freedom. And there you have it. If you learned a thing or two from this video, please leave a thumbs up and comment down below what you want to learn next. Subscribe for more.